When applying the Fibonacci wedge, it's generally best to avoid situations like this, where initially there's a steep drop, quickly followed by price stabilizing to a shallower angle. And in this case, since a large downtrend is developing further, we'll have to reference a major area of support potential and the site of a clear major upswing that is below where price is currently at. Then we have the two clear downswing points. Go to the highest point where the downtrend initially began, then take the second point straight down to be horizontally in line with the lowest price level that was referenced. Finally, rotate the third point up to place a downtrend line that runs through the downswing points. The portion of the downtrend line that extends past the boundary of the wedge has potential, albeit theoretically weaker potential, to resist rising price, even when there's just a moderate increase of green volume upon contact with this trend line. It's possible to extend the vertical line lower to expand the wedge by placing the second point of the wedge horizontally in line with the lowest price level of a significant bullish reversal area. In a scenario with a large trend like this, conditions are less suitable compared to a situation where a wedge can be applied over a shorter time span and price range. And it's even better if within a defined horizontal range, we can reference a series of sharp and clear swing points that have recently formed. Although the most recent upswing point around this area does go lower than the previous upswing points, it's not significantly lower to make a huge difference in this case. Our lowest point to apply the Fibonacci wedge with this method needs to be referenced from an upswing point that took place before the formation of the two downswing points we'll be using for the trend line, rather than an upswing point that took place between or after the formation of these two downswing points. Like normal, we start from the highest point of the first downswing and go straight down to be horizontally in line with the lowest level of the upswing point that took place before the two downswings. Then we form a trend line running through the two downswing points by rotating the third point up. Since price keeps making newer lows at this lower boundary, the coverage we get from this wedge isn't as useful for determining the potentially stronger and weaker portions of a downtrend line. That's why as the chart progresses to reach lower, we need to adjust and plot a new Fibonacci wedge with more recent swing points. And it's possible this process will have to be repeated several times due to the maintenance of this neutral to bearish posture that does see the breakthrough above shorter term trend lines after the boundary of a Fibonacci wedge. However, after briefly closing over these downtrend lines, no significant uptrend develops to move the chart out of this neutral to bearish context. Now this time when we apply the wedge in the same way, there's the usual break of the trend line after its strongest resistance potential within the boundaries of the wedge is passed. This also helps identify the weaker intersection of the trend line by the time there's contact with the upper portion of a potential double bottom range. With persisting resistance at previous highs, we could be repeating the same process of applying a Fibonacci wedge in the same approximate price range if we soon get a lower downswing point to maintain the bearish to neutral posture on the chart. Since this doesn't occur and price finally breaks higher, we wait until this new larger uptrend begins to end and form those familiar characteristics for the application of a Fibonacci wedge in a bearish context. Then when price eventually does return back up to contact this trend line, we need to pay attention to that short-term bullish context because that recent influx of buyers entering the market is more than sufficient to break over the downtrend line, especially now that it's contact with the downtrend line after the boundary of the Fibonacci wedge. We chose this more recent upward reversal area, even though it was less significant compared to the double bottom reversal, because this was closer to where price was trading at, and the chart did not end up closing below this area. So it was better to keep things in this shorter and more relevant context. Though if we did extend down to the lows of that upward reversal from the double bottom, we could see the discrepancies where price is able to cross over this stronger portion of the downtrend line within the boundary of the wedge, rather than the theoretically weaker portion after the wedge, without a major spike in green volume being maintained during contact with the trend line, which is possible but generally less common. It's more common for this stronger portion of a trend line within the boundary of a wedge to be broken through with higher sustained levels of volume. However, as we've seen in previous examples, it's quite possible to break over a trend line during the weaker portion after the boundary of a wedge with lower levels of volume.